Hi and welcome to Carnegie and our interview with Bergman Beving. My name is Markus Almerud. I'm an analyst here at the bank. I have with me Magnus Söderlind, who is CEO at Bergman. A warm welcome to you.
Thank you very much.
You released earnings this morning.
Yes.
Another good report.
Yes, thank you.
Maybe we start with the top line. You saw minus 12% organic growth,
Mm.
but you also say that the majority of this is market. Construction markets, still difficult, but industrial is also coming down a bit.
Mm.
Elaborate a little bit about what you're seeing in the market. What are you seeing on the ground?
Mm. As you mentioned, we had a negative organic growth with 12% this quarter organically. And that is mainly due to that we continue to phase out low margin, high volume products to focus our business on areas where we have good margins and good future outlook. But also this quarter we faced some tougher market, especially within the industrial sector that was very stable up until the autumn. And the construction sector, I would say, is on the same level. But despite this, we still performed a profit increase of 7% in this quarter.
Mm-hmm. But so you did see a bit of deterioration, you would say, sequentially in the quarter from the industrial
sector. I would say organically the top line declined with 12%, and the majority of that is due to the kind of tougher market conditions, and part of this is still due to the phase-out activities we are doing.
If we go back to that last point, the phasing out of unprofitable products, which has been going on for a couple of years now.
Couple of quarters at least.
Couple of quarters at least. But how far gone are we? Almost there? Because it sounds like now it's more market than unprofitable products and phasing out, as opposite to what it was before. Are we at the end of this journey now?
Yeah, as you say, we have been doing this for several quarters. We have a gross margin increase of 4% unit this quarter. Mm-hmm. So we see the effect of the activities we have been doing, and we have a steady improvement of the gross margin quarter on quarter. We still have some phase out to do, but we get to the end here in the next 1 to 2 quarters from now.
Mm-hmm. And we'll come back to the margin because impressive margin expansion, especially on the gross profit level. But we stay a little bit with the organic growth. Last year we talked a bit about these spring orders, specific, but still you took quite a big hit from that. What does it look like this year?
One of the biggest companies, or the biggest company in the building material division, is called SV, and they are the market leader within fastening and screws within the Nordic region. And typically their customers pre-order that is then delivered in the spring, so they should be able to deliver during spring and summer. So that's kind of the business as such. And if we look at the spring order volume this year, it's on the level of last year. Okay. And the year before, I would say, was an all-time high.
Okay. So no further deterioration nor any pickup should be expected from this particular item?
No, I would say it's stable.
Mm-hmm. And if we look at the M&A market, so you did 8 acquisitions last calendar year, which is a pickup in terms of pace.
Yes.
What does the M&A market look like, the environment that you're facing, and what does your pipeline look like?
I would say acquisition-wise, the market is very good for us. 1.5, 2 years ago, there was many companies out there acquiring companies, and we perceived, especially in Scandinavia, that the kind of valuation was accelerating. Now there are much fewer buyers out in the market. Many of those who are out there are now focused on reducing debt. We have a very strong balance sheet, so we can kind of leverage from this opportunity. As you said, we acquired 8 companies last calendar year. So for us, I would say the market is looking very good and promising, and we have a good pipeline.
And if you look at the number of conversations, if you try to gauge kind of the pace going forward from the kind of number of conversations you've had, and you look at the number of conversations throughout the year, has it been kind of stable or increasing, or is it just that it's easier to close them?
I would say my expectation on this calendar year is that we will continue on the same level as last year, roughly.
Okay. And the expectations from the sellers have come down. We talked about that. Is it mainly less competition from the buyer side, or are there other reasons as well why the market has
I think, as you're saying, it's less competition, but I also think that our business model and we as a company is much more appreciated as a buyer currently. Back in in the days, there were many that had an extreme fast development and promised a lot of things, and maybe they have seen what they deliver in the end. We have been around for 100 years, so we have a very strong proven track record to care of companies and have developed them over time. So I think also that we are more appreciated in the buyer market today. They see us as a good, stable, trustworthy owner going forward. So I think that is also playing in our hands.
And the margin, if we talk about the margin
Yes.
expansion is quite impressive. I mean, 4 percentage points gross margin expansion is quite dramatic. And then you continue to drive the EBITDA margin as well. What are the main components of this drive?
Yeah, the main component is actually organic gross margin improvement. It's the result of the phase out of low margin, high volume products that's now is visible clearly in the gross margin development. So that's the majority, and it's then spiced of the acquisition we made that all have a profit margin above 15% and also have very healthy, good gross margins. So it's a combination of both, but the organic improvement is the majority of that gross margin improvement that you see.
And is there more to do on the organic side, or going forward will it be mainly acquisitions with higher margins coming in driving the margin?
Yeah, it relates to your previous question about have you phased out the low margin yet? Yeah, of course we have still some things to do, but the kind of big kind of improvement is in the figures already today.
Yeah. And we talked a little bit about at the call and report you lift out the proprietary products.
Yes.
And you have a target going to 75%.
Yes.
Is that also mainly going to come from acquisitions? So that you
it will be a combination of acquisition, but we also our capital allocation model, the focus model, is kind of directing where we should put investments for growth. And then if they have a low profitability, we don't want the company to grow top line. We want them to focus on profitability, and that includes margin improvement and cost reduction and those things. So those that are on the low end of our kind of profitability measurement will then typically continue to reduce revenue, and that's typically not the product companies. So that will kind of shift the portion on a group level, and together with more acquisition on product companies will then get improvement of percentage of the proprietary products in the group. And
if we pick up a little bit on what you said there, you talked about a little bit about targets and what you are looking for in your companies, in your subsidiaries. You updated your targets last year, and you now refer to them as 500, 10, 45.
That's correct.
Explain a little bit of what this refers to.
Yeah, the 500 is that we have set the target to reach 500 million EBIT result latest fiscal year 25-26. That ends March 26 then. And that have we been communicated as a target several quarters. But we added in the last quarter the target to reach an EBIT margin of at least 10% the same fiscal year, and then reach our profitability target, that's profit of working capital, of 45% the year after that. So that's 500 million in EBIT at least 10% EBIT margin and a profit over working capital of at least 45%.
And the 45% profitability target, would you say that is the most challenging one?
I think we need to work on all dimensions to get in all those. There is work to be done, but we have activities and plan to get there. So, I mean, we should be able to reach that, but it will not be easy.
Because the 45% profitability target, the working capital over profit, that would drive considerable cash flow as well.
Yes.
So, on that, you've specified how much you cover acquisitions, which also lift out. And you're talking about 50 to 80 million kronor per year in M&A.
Yes.
And that's on the profit level.
Yes.
So I assume that your balance sheet is no problem, or do you need to reach the other targets, and particularly the 45%, to kind of fulfill that, or do they all?
No, I mean, we have quite a low debt level, so we have the capacity also, if we refer to the credit lines we have with our finance institutions, so we don't see kind of that will require something else to improve. So I would say even keeping the same cash flow and profit level that we have today organically, we will have the headroom to acquire the 50 to 80 million per annum in profit through acquisitions.
Magnus, a big thank you for coming here to talk to us.
Thank you very much.
And good to see a good quarter again, and looking forward to keep following your journey.
Yeah, please do. Thank you.
Thank you for watching.
Thank you.